Microeconomics for Investors, Chapter 12, Corporate Incentives. Section 1, Management Incentives. Management incentives matter because they shape behavior long before investors see the results in financial statements. In most public companies, shareholders own the business, but executives make the daily decisions, so incentives become the bridge between ownership and control. If that bridge is built well, managers are more likely to act in ways that support long-term value creation rather than personal convenience or short-term optics. If it is built badly, talented managers can still be pushed toward actions that hurt the business. That is why compensation design is not a side issue in governance. For investors, it is one of the clearest clues about what leadership is actually being encouraged to do. Executive pay usually has several parts, and each part sends a different signal. Base salary provides stability and helps retain leaders, but by itself, it does not strongly push performance. Annual bonuses create urgency around near-term goals, which can be helpful if the goals are well chosen. Equity compensation, such as shares or options, is meant to make executives care more about the company's value over time. The important point is that the mix matters as much as the amount. A company paying mostly in cash may get very different behavior from one paying heavily in long-term equity. Incentives always create a time horizon. Annual bonuses tend to pull attention toward this year's targets, while equity that vests over several years can push managers to think more about what the company will look like in the future. A strong plan tries to motivate performance today without encouraging managers to borrow value from tomorrow. Too much short-term pay can lead to short-termism, such as cutting investment to protect earnings. But too much upside, especially through auctions, can also create a taste for excessive risk. Good design is a balancing act between urgency and patience. A sound incentive plan usually starts with business goals, not with pay levels. The company first has to decide what it is truly trying to achieve, such as stronger returns on capital, healthier cash flow, or disciplined growth. From there, it chooses metrics that capture those goals well enough to guide behavior. Only after that does it decide how much of pay should come from salary, bonus, or equity. The final step is setting thresholds, target payouts, and caps so rewards rise with performance but do not become disconnected from reality. When this sequence is reversed, companies often end up rewarding whatever is easy to measure rather than what actually creates value. Even a thoughtful plan needs safeguards, because raw incentive power can be abused or distorted by luck. Vesting schedules help by delaying full rewards, so executives have to live with the longer-term consequences of their decisions. Performance hurdles make sure equity or bonuses are earned only if meaningful results are achieved. Clawbacks add accountability by allowing a company to recover pay after restatements, misconduct, or serious errors. Payout caps also matter because they prevent windfalls that may come from industry conditions or a market boom rather than management skill. These guardrails do not eliminate problems, but they make alignment much more credible. Incentives go wrong when they reward a narrow outcome and ignore the wider business. People naturally optimize for what they are paid to optimize for, even if that metric is only a partial picture. A revenue target, for example, may encourage discounting or low-quality growth that weakens margins. Option-heavy compensation can make risky bets feel attractive because the upside is large while the personal downside is limited. Even operational targets can backfire if managers improve speed or efficiency by damaging quality or customer service. The lesson is simple. The metric may improve while the business gets worse. The Apex retail example shows how a sensible metric can still create a bad outcome. Inventory turnover is a real measure of efficiency, so rewarding improvement in it is not inherently foolish. The operations manager responds exactly as the plan intends and raises turnover enough to earn a larger bonus. But the easiest way to do that may be by carrying less stock, trimming variety, or delaying replenishment. That improves the chosen metric while increasing stockouts, frustrating customers, and losing sales. In other words, the manager wins on paper while the company absorbs hidden costs that the metric did not capture. What this teaches is that the problem was not inventory turnover itself. The mistake was treating one metric as if it represented the whole business. Retail performance depends on trade-offs between efficiency, availability, margin, and customer experience. so a stronger plan would measure more than just turnover. Adding in stock availability, gross margin, or service quality would make it harder to improve one number by damaging another. That is the logic behind a balanced scorecard. Better incentive design rewards the right trade-offs, not just the easiest visible win. For investors, compensation plans are useful because they reveal likely managerial priorities. If a plan leans too heavily on a single metric, that is a warning that behavior may become distorted. Too much emphasis on annual bonus pay can also signal a short time horizon, especially if long-term equity is limited. Weak accountability rules such as no payout caps or no clawback provisions suggest management may keep rewards even when outcomes later unravel. Excessive complexity is another red flag, because if the plan is hard to understand, it may be hard to govern. Durable value is more likely when incentives are balanced, transparent, and tied to multi-year results. This software CEO package has both sensible elements and obvious risks. The 4-year vesting on options encourages some long-term focus, but the annual bonus tied only to revenue growth could easily push the CEO to chase sales at the expense of margins or cash flow. In a software business, that might mean aggressive discounting, overspending on customer acquisition, or weak discipline on profitability. The options layer adds another issue because it can reward upside strongly without imposing much personal downside if risky decisions fail. A better package would add a second metric such as operating margin or free cash flow, so growth has to be profitable. Guardrails like payout caps, pure relative measures, and clawbacks would further strengthen alignment. Section 2. Shareholder alignment. Shareholder alignment is the idea that the people running the company should make decisions as if they were thoughtful owners. Shareholders supply the capital and bear the economic results, but managers and directors control operations, strategy, and capital allocation. That separation creates a natural risk that decision makers may pursue what is best for themselves rather than what is best for owners over time. Alignment mechanisms are meant to narrow that gap. Good pay design, board oversight, and shareholder input all help managers think more like long-term owners. The goal is not short-term stock price support, but durable owner value. Misalignment can destroy value even in an otherwise strong business. A company may have a good product, healthy demand, and solid cash flow, yet still deliver poor investor outcomes if leadership is rewarded for the wrong things. One common problem is empire building, where managers pursue growth, acquisitions, or scale, even when returns are weak. Another is excessive caution, where leaders avoid worthwhile projects because failure could hurt their career or compensation. Poor alignment can also produce quarterly earnings management that flatters short-term results while undermining long-run economics. This is why investors should never assume that a good business automatically means good stewardship. When alignment is good, the benefit shows up in decisions, not just in governance documents. Capital is more likely to go to projects with strong returns rather than to vanity expansion or low-quality deals. Growth becomes more disciplined because management has a reason to reject opportunities that add size but not value. Accountability also improves since rewards are more clearly tied to real outcomes instead of excuses or market luck. Over time, that usually leads to more durable performance. Good alignment is really a way of improving judgment inside the firm. Companies use several tools to build alignment, and each one works differently. Proxy voting gives shareholders formal power on major company matters, such as directors or certain strategic decisions. Say on Pay lets owners express support or concern about executive compensation, even though the vote is often advisory rather than binding. Independent boards provide oversight between annual votes by monitoring management, strategy, and risk. Performance-based pay influences day-to-day behavior by linking rewards to results. None of these tools is enough alone, but together they create a system of checks and incentives. These tools differ in both timing and force. Proxy voting is the clearest formal power shareholders have, but it is used only on certain issues and usually at specific moments. Say on Pay is more of a signal because it communicates dissatisfaction without automatically changing the package. Board oversight is continuous, which matters because many important decisions happen between shareholder meetings. Compensation design works in the background every day by shaping what management pays attention to. The combination creates discipline, but it does not guarantee good outcomes if the tools are weak or used passively. It is important not to confuse shareholder alignment with maximizing this quarter's profit. Long-term owners often benefit when a company accepts lower current earnings in order to fund projects with strong future returns. Cutting research, delaying maintenance, or avoiding capacity expansion may boost short-term numbers, but that can weaken the business later. Real alignment means management is disciplined about value creation, not obsessed with immediate accounting results. Shareholders who plan to own the business for years usually care more about future cash flows than temporary earnings polish. So alignment should support smart investment, not just near-term profit targets. A strong alignment system works as a connected process. The company starts by defining goals that actually create value, such as returns on capital, cash flow growth, or durable competitive strength. Compensation is then built to support those goals through an appropriate mix of salary, bonus, and long-term equity. Independent directors review the design, monitor results, and make sure management is being judged fairly but firmly. Shareholders then provide feedback through voting and engagement, while disclosure allows investors to compare pay with performance. Each piece reinforces the others, which is why alignment is best understood as a system rather than a single rule. Mapletech's plan is a good example of alignment through time horizon and metric choice. Most target pay is tied to 3-year free cash flow growth, which pushes the CEO to focus on durable cash generation rather than just revenue or short-term earnings. The additional restricted stock still gives the CEO exposure to the company's long-term value, even without a performance hurdle on that portion. Because actual free cash flow growth reached only 18% instead of the 25% target, payout falls below target. That is exactly what investors want to see in a well-designed system. Pay responds to results rather than being insulated from them. The Mapletech example shows that alignment is about making rewards move with value creation, not about guaranteeing success every year. If management invests heavily early on, near-term cash flow may look weaker, but that can still be sensible if those investments later produce stronger returns. A good plan allows that logic by judging performance over multiple years. When free cash flow eventually improves, management can earn more because shareholders are also better off. That is healthier than paying generously for short-term appearances. Investors should want compensation systems where later success is rewarded and weak outcomes reduce pay. Alignment can still fail even when the governance structure looks impressive on paper. A board may be independent in name but too passive to challenge management. The chosen metrics may reward the wrong behavior, so the plan appears disciplined while still encouraging bad decisions. Shareholders may also fail to use their voting rights or may focus only on headlines instead of substance. And in difficult periods, short-term pressure from markets can overwhelm a sensible long-term strategy. The real test is whether the system changes behavior in practice, not whether it sounds good in a proxy statement. Many alignment mistakes come from oversimplifying the problem. Overweighting annual earnings targets can push managers toward cosmetic improvements instead of durable value. Using too many compensation metrics creates a different problem, because the system becomes so complex that accountability weakens. Another mistake is focusing only on executive pay and ignoring the broader governance system, including boards, voting, disclosure, and incentives deeper in the organization. Investors also need to avoid confusing alignment with profit growth at any cost. The best systems are simple enough to understand, broad enough to matter, and long-term enough to support real value creation. Section 3. Executive compensation. Executive pay matters because it influences how top leaders behave, not just how much they earn. The structure of compensation can affect how aggressively executives pursue growth, how much risk they take, and whether they favor immediate results over long-term value. This is especially important because senior leaders control capital allocation, strategy, and major operating priorities. A well-designed package can reinforce discipline and owner-oriented thinking. A weak package can reward decisions that look good briefly but damage the business later. For investors, executive pay is best viewed as an incentive system disguised as a compensation schedule. Most executive pay packages have 4 main parts, each serving a different role. Base salary is fixed cash pay and mainly provides stability rather than strong incentives. The annual bonus creates a 1-year performance target, often tied to financial or operating goals. Equity awards, such as restricted stock, performance shares, or options, connect part of executive wealth to the company's longer-term value. Perks and benefits are usually smaller in economic importance, but they can still raise governance concerns if they seem excessive or symbolic of weak oversight. To understand a package, investors should always ask which of these pieces dominates. The amount of pay matters less than the behavior each component encourages. Salary makes executives less vulnerable to year-to-year swings, but it does little to motivate outperformance. Bonuses create focus and urgency around annual goals, which can be helpful if those goals reflect real economic progress. Equity is usually the strongest tool for long-term alignment because it makes management care more about what happens to the company's value over several years. Perks, by contrast, may say more about governance culture than about operating incentives. So the key question is not just how much an executive is paid, but what the package teaches that executive to care about. The hardest design problem in executive pay is balancing today and tomorrow. Boards want executives to deliver current performance, but they do not want that performance purchased by cutting investment, postponing maintenance, or taking reckless risks. Plans that lean too heavily on annual profit can encourage exactly those behaviors. Near-dated options can create another problem by rewarding short-term stock price spikes and inviting volatility. Multi-year vesting, deferred compensation, and clawbacks all help push attention further into the future. Strong pay design works when executives can improve their own outcomes only by improving the company's durable outcomes. Performance metrics are powerful because executives usually optimize what gets measured and rewarded. If compensation emphasizes revenue growth, leaders may expand aggressively, even if the quality of that growth is poor. If it emphasizes earnings per share, buybacks may become unusually attractive because they can mechanically lift EPS. Operational goals can add useful context by bringing in customer retention, efficiency, safety, or service quality. A mixed set of metrics is often healthier because it reduces the chance of gaming any single number. For investors, metric choice is one of the clearest windows into what behavior the board is encouraging. Executive pay is typically set through a formal governance process, not by the executive alone. A compensation committee made up of independent directors usually leads the work, often with outside benchmarking or consultant input. The committee sets salary and target bonus levels, then decides on long-term equity grants and their vesting or performance terms. After the performance period, it reviews results and approves actual payouts. Finally, the company discloses the package to shareholders, who can evaluate it and often vote on say-on pay. This process matters because the credibility of compensation depends heavily on who designs it and how disciplined that review is. This manufacturing example shows how one package can create multiple incentives at once. The base salary provides stability, while the EBIT-linked bonus pushes the CEO to care about current operating profit and cost discipline. The restricted stock units that vest over 4 years encourage the executive to think beyond this year's income statement. The performance shares tied to 3-year total shareholder return go further by making a portion of pay contingent on longer-term owner outcomes. That mix can work well because it rewards both current execution and future competitiveness. The real test, of course, is whether those measures are used in a balanced way rather than allowing one target to dominate. Poor executive pay plans tend to produce familiar problems. Heavy reliance on short-term stock price can reward optics, timing, or market sentiment rather than underlying performance. Weak peer groups can also ratchet pay upward by making packages look reasonable against a poorly chosen comparison set. Missing clawbacks reduce accountability when results later prove misleading or misconduct is uncovered. Single metric plans are easy to game, and excessive severance can blunt the personal consequences of failure. That is why investors should look past headline compensation figures and study structure, incentives, and downside exposure. A practical review of compensation starts with the proxy statement and a simple question. What is the CEO actually being paid to do? First, compare base salary with total compensation, because the relative size of the variable portion tells you how incentive-driven the package is. Then estimate how much pay comes from equity rather than cash, since that affects time horizon and alignment. After that, identify the bonus and equity metrics and ask what decisions those measures are likely to encourage. Vesting schedules are also crucial because a 5-year horizon creates a very different mindset from a 1-year horizon. By the end of the review, you should be able to say whether the package favors short-term targets, long-term value, or some mix of both. Section 4. Capital allocation. Capital allocation matters because every dollar a company generates has to be sent somewhere. Management can reinvest it, use it for acquisitions, return it to shareholders, or reduce debt, and each choice shapes the company's future. These decisions affect growth, but they also influence risk, resilience, and financial flexibility. That is why capital allocation is one of the clearest tests of management quality. A good team consistently directs cash toward its highest value use. A weak team may still grow the business, but in ways that destroy shareholder value. Most companies face the same basic menu when deciding how to use cash. They can reinvest in the existing business through projects such as new capacity, product development, or technology improvements. They can acquire another company to gain scale, enter a new market, or add capabilities. They can return cash to shareholders through dividends or buybacks, or they can pay down debt to strengthen the balance sheet and reduce interest burden. The analytical challenge is not identifying the options, it is comparing them honestly and choosing the one that creates the most value. Capital allocation choices also send signals about how management sees the business. Reinvestment often suggests confidence that the company still has good internal opportunities with attractive returns. Acquisitions can signal a desire for faster expansion, though investors should ask whether that growth will be profitable. Buybacks may indicate that management believes the stock is undervalued, but they can also be used carelessly at high prices. Debt repayment may reflect caution, or it may reflect a sensible focus on resilience and flexibility. None of these signals is automatically good or bad, so context matters more than labels. A disciplined management team uses the cost of capital as a hurdle when comparing options. The basic idea is that a project or use of cash should earn more than the company's cost of financing after adjusting for risk. Growth by itself does not create value if the return is too low. A flashy acquisition earning 6% is less attractive than a steady internal project earning 12% when the cost of capital is 8%. Risk matters too, because a riskier use of cash should demand a higher expected return. This framework helps investors distinguish between expansion and genuine value creation. Good capital allocation is usually the result of process, not instinct. Management first identifies how much cash is truly available after operating needs are covered. It then compares the available options on a risk-adjusted basis rather than treating each category separately or emotionally. Strategic fit also matters, because even a positive return project may be a poor use of capital if it distracts from the firm's advantages or stretches the balance sheet. After choosing, strong teams review actual results against what they expected. That feedback loop is what turns capital allocation into a repeatable skill. Available cash is not the same thing as total cash generated from operations. A company must first fund the spending required to keep the business running and competitive, including necessary capital expenditures. Only the remainder is truly allocable. In the example here, a business generates $100 million from operations, spends $30 million on required capital needs, and is left with $70 million to deploy. That remaining cash is what management can compare across buybacks, debt repayment, acquisitions, or additional investment. Investors should always make this distinction, because companies sometimes speak as if all cash generation is freely available when it is not. This Midwest manufacturing example shows how capital allocation becomes a ranking exercise. The new factory earns 15% against a 9% cost of capital, so it clearly creates value and deserves serious consideration. The acquisition earns only 6%, which is below the hurdle and should be rejected even if it looks strategically exciting. The buyback may also be attractive if the shares are worth $65, but trade at $50, because repurchasing undervalued stock effectively buys a good asset cheaply. Debt paydown offers a lower direct return, but it still reduces interest costs and financial risk. A thoughtful team ranks all four rather than assuming growth projects automatically come first. The final decision in this case is sensible because it focuses on value, not appearances. Management funds the factory because it clears the hurdle and creates economic value. It authorizes the buyback because repurchasing undervalued shares can benefit remaining shareholders. It also reduces some debt, improving resilience and lowering financial risk. Most importantly, it rejects the acquisition even though acquisitions often look exciting and can make a company appear more ambitious. The lesson is that disciplined capital allocation means saying no to growth when the economics do not justify it. Investors can often spot weak capital allocation by looking for a few recurring mistakes. One is doing acquisitions that fail the hurdle rate simply because management wants scale or headlines. Another is assuming every buyback is shareholder friendly, even when shares are expensive. Companies also make mistakes when they skip rigorous return tests for internal projects, treating reinvestment as automatically good. Some teams compare options inconsistently, using one logic for debt paydown and another for acquisitions or buybacks. When management cannot clearly explain expected returns, strategic fit, and trade-offs, that uncertainty itself is a warning sign. Using a 10% cost of capital, the solar project looks strongest because a 14% return comfortably clears the hurdle. The buyback also looks attractive if the shares are worth $40 but trade at $30, since purchasing undervalued stock can create meaningful value for remaining owners. Debt reduction is helpful as well, especially if the company wants more resilience, but a 6.5% debt cost is still below the hurdle, so it is usually less attractive than a high-return project. The Gridco deal is the weakest option because its return falls to 5% after integration costs. So the likely ranking is solar project first, buybacks second, debt reduction third, and the acquisition last. The exercise reinforces the habit of ranking all choices by value creation rather than by category or excitement. Section 5. Agency problems. An agency problem exists when the person making decisions is not perfectly aligned with the person bearing the economic consequences. In corporations, the classic case is managers acting as agents and shareholders acting as principals. Managers choose strategy, spending, risk levels, and operating priorities, while shareholders absorb the gains or losses from those choices. The key point is that conflict can exist even without dishonesty or bad intentions. A manager may simply respond rationally to career concerns, compensation rules, or personal preferences. Agency problems are therefore built into the structure of separated ownership and control. Agency problems arise in corporations because ownership and control are usually separated. Shareholders provide the capital and want long-term value, but they do not run the business every day. Managers control operations, strategy, and capital allocation, so they have far more influence over outcomes. Their goals may overlap with shareholder interests, but they may also care deeply about job security, prestige, compensation, or avoiding blame. That creates room for conflict even in well-run companies. Public markets make this especially common because the owners are dispersed while decision-making power is concentrated. Two forces usually drive agency problems. The first is uneven information. Managers know much more about the business than owners do, and outside investors cannot fully observe effort, trade-offs, or hidden risks. The second is diverging goals. Even with the same information, managers and shareholders may prefer different choices. Owners may want the highest risk-adjusted value, while managers may prefer safer decisions that protect their career or income. When those two forces combine, misalignment can shape real business decisions. That is why agency problems are economic problems, not just philosophical ones. Agency costs are real economic costs, not just abstract governance concerns. One part is lost value from poor decisions, such as bad acquisitions, underinvestment, or growth pursued for the wrong reasons. Another part is monitoring cost, including boards, audits, reporting systems, and oversight processes designed to keep management aligned. There are also bonding costs, such as contracts, performance pay structures, and other commitments meant to reassure owners. All of these consume resources. When you add direct control costs to hidden value destruction, the total agency cost can be large. Some of the most damaging agency problems show up in ordinary business decisions. A manager may delay maintenance to boost current earnings, even though that raises future breakdown costs. Another may cut research and development to protect a bonus, sacrificing future innovation for present income. Managers may also avoid good but risky projects, because personal downside feels larger than shareholder upside. In other cases, they may chase acquisitions for status or hoard cash to avoid scrutiny and preserve control. These are not always dramatic scandals, but they can quietly erode value for years. Governance exists to reduce agency problems, but eliminating them completely is neither realistic nor efficient. Boards, audits, reporting, and compensation rules can all improve alignment, yet each control mechanism has a cost. Too little oversight leaves room for wasteful or self-serving behavior. Too much oversight can make a company rigid, slow, and bureaucratic. The goal is to reach the point where the benefits of control exceed the cost of imposing it. Good governance is therefore a balancing problem, not a search for perfect control. This retail example shows how an incentive can produce a superficially strong result while destroying value. The CEO is paid mainly for same-store sales growth, so management uses heavy discounting to hit the target. Revenue rises, and on the chosen metric the plan appears successful. But margins fall, profits weaken, and shareholders are worse off. The CEO still earns the bonus because the narrow target was met. That is a classic agency problem. The agent is rewarded even though the principal loses. Boards should ask a deeper question than whether management met the target. They need to ask whether the outcome created economic value for owners. Was the growth profitable and sustainable, or did it come from discounting, underinvestment, or balance sheet strain? Did the incentive plan encourage the right trade-offs between growth, margin, risk, and long-term positioning? And if shareholders had been making the decision directly, would they have wanted the same choice? These questions shift attention from box checking to owner value, which is where oversight should focus. Agency problems are often misunderstood because the most visible conflicts are not always the most important. They do not require bad faith. A manager can act honestly and still respond to incentives in ways that hurt owners. Visible perks attract attention, but poor capital allocation usually matters far more than a private jet or an expensive office. Investors also need to remember that growth is not the same as value creation. Agency problems can exist in private firms as well, and shareholder activism does not solve every case. The real issue is whether incentives consistently push decisions toward long-term owner value. In the acquisition case, the right analysis starts by asking who benefits first. If the deal pushes revenue above a bonus threshold, the CEO may gain quickly even before the acquisition proves its worth. Shareholders, meanwhile, bear the downside from integration problems, debt burden, and overpayment risk. There is also an information problem because management may know more about the true synergies, risks, or internal motives than outside owners do. That combination makes the proposal a classic agency case. Better compensation design would reward durable value creation through measures like cash flow, returns on capital, or multi-year performance rather than a narrow revenue target.